The market just sent a loud wake-up call to investors. On June 5th, the Nasdaq suffered a 4% plunge. This wasn't just a minor dip, it was the worst single-day performance we've seen since April of 2025. For the week, the index slid 4.7%, leaving many wondering if the tech-led rally has finally hit a wall. The initial spark came from Broadcom. Their soft guidance for AI chip demand caught the market off guard. As a major bellwether for the AI sector, this lowered forecast sent ripples through the entire semiconductor industry. But the real weight came from the May jobs report. 172,000 jobs were added, nearly double expectations. In a normal environment, that's great news, but today it instantly revived fears that interest rate hikes aren't over. A hot labor market gives the Federal Reserve more room to keep rates higher for longer to combat stubborn inflation. Chip names that had tripled or more in 2026, like Micron, SanDisk, and Marvell, faced a violent sell-off. These high flyers saw months of gains wiped out in hours as investors rushed to lock in profits and rotate out of tech. This brings us to the inevitable comparison. Are we reliving the dot-com bubble burst of the year 2000? Valuation metrics are certainly flashing warning signs. The Shiller CAPE ratio is currently hovering near all-time record highs. When we look at forward PE ratios, they are beginning to mirror the levels seen at the peak of the dot-com mania. Back then, the Nasdaq fell nearly 80% over 2 years. The question today is if this is a shakeout or a top. However, a deeper look at the data reveals some massive differences that the bubble bears might be overlooking. In 2000, there were 22 Nasdaq 100 companies that were up over 400%. Today, that number is only 6. While growth is concentrated, it is nowhere near the broad-based euphoria of the 90s. Crucially, today's leaders are generating massive cash flows and real profits, unlike many of the dot-com hopefuls. We're also on the cusp of an AI mega IPO wave. Think about names like SpaceX and other AI giants still private. This entire cycle is fueled by massive energy demand and infrastructure needs that simply didn't exist 25 years ago. This isn't just about software, it's about the physical expansion of technology into energy, space, and robotics. So, how should you be managing your portfolio during this volatile period? I'm going to share exactly what I'm doing. My first rule is simple. Stay invested and continue to dollar cost average. Volatility is the price we pay for returns. By buying regularly, you naturally lower your average cost basis during these pullbacks, setting yourself up for the recovery. I also maintain a 20% treasuries buffer. This provides essential liquidity when tech stocks are on sale. This buffer allows me to stay offensive when everyone else is panicking, rebalancing back into equities at lower valuations. It's easy to talk about staying calm, but much harder to do it when you see red on your screen. Perspective is key. Consider the worst market entry in history, the 1929 crash. If you entered at the absolute top and simply stayed invested for the long run, you still ended up ahead. Time in the market beats timing the market. The power of compounding requires you to stay the course through the drawdowns to capture the subsequent rallies. Focus on the data, not the headlines. The Nasdaq 100 companies are still dominant global leaders with huge moats. These companies provide the digital infrastructure for the modern world. Their utility is much higher than in 2000. Risk management isn't about avoiding the dip, it's about being positioned to survive it and thrive on the other side. A resilient portfolio accounts for volatility by diversifying across sectors that benefit from different economic drivers. Part of that positioning is making sure your overall financial health is in order, especially if you're looking to make a move. If you're planning on buying a home or refinancing, you need to be prepared for whenever the right opportunity strikes. Check out the Get Mortgage Ready app. It helps you track your readiness and ensures you're in the best position for a loan. I put a link in the description for you to get started today. Don't let market noise distract you from your goals. Whether it's home ownership or long-term wealth building, the principles of patience and data-driven decisions remain the same. The Nasdaq might be volatile right now, but the underlying narrative of innovation and growth is still very much intact. History has shown us time and again that the market is resilient. Those who stay the course are the ones who win. So, take a breath, look at the data, and stick to your plan. Success in investing is often just a matter of staying power. If you found this deep dive helpful, please like and subscribe for more data-driven market updates every week. Stay informed, stay invested, and I'll see you in the next one. Let's build that long-term wealth together. Check the link in the description below to get started on your mortgage readiness journey today. Thank you for watching. Remember, the best time to start was yesterday. The second best time is right now. One final data point. AI infrastructure investment is projected to hit new highs by the end of this year. Global tech demand is also diversifying, creating more moats for the companies we already know and trust. While rates matter, innovation has historically outpaced inflation over any 5 to 10-year period. Stay focused on your foundations. We'll be here to help you get mortgage ready and market wise. See you soon.